hearing. Of course, our thanks to Lisa, Clement, and Katrina for keeping us on track on the technology. We appreciate our staff. And Martha and I were just so brokenhearted last night at about 8:30 when we learned about the loss of Carol Barr. I can't imagine the pain that Andy feels. So all of us on the committee share that bond of affection for Andy, and we wish him comfort during this tough time. Mr. Chairman, glad to have you back before the committee. And you've done an excellent job today talking about the facilities, the challenges with the facilities, talking about your concerns about how to maintain some fiscal support in the unemployment area particularly, and your concern about small businesses. So thanks for being so thorough in your answers. As the ranking member on the Monetary Policy Subcommittee, I wanted to turn and talk about the balance sheet of the Fed and monetary policy, and just put some parameters on it as we are in COVID-19 now. And again, thank you publicly for the outstanding job that the Board of Governors did in early March to bring liquidity back to the system and preserve people's access to capital by keeping our capital markets functioning. But I do want to talk about how we measure monetary policy going forward now as we, as you say, enter that midpoint of the return to economic recovery. The balance sheet was about $4 trillion before the pandemic hit, and there was a lot of concern over it at that level in terms of a percentage of GDP and the like. And very quickly, dwarfing anything in the QE days, you have added $3 trillion to the balance sheet, and we're close to $7 trillion. Do you see that range of pre-COVID of 16 to 17% of GDP still a post-pandemic target based on reserves that you see the balance sheet returning to?
I hadn't thought of an actual target, though, but I would say this. In the long run, the size of our balance sheet will be dictated by the public's demand for our liabilities, the two biggest of which are currency and reserves. And so we felt that we were getting really close to that demand at the level you suggest. So, that would tend to be roughly constant over time, I guess, as a percentage of GDP. So it's a place to get back to.
And at the peak in 2014, you owned about 21% of all new issue treasuries and about 40% of new issue agency MBS. And in this most recent phase this spring, as you expanded the balance sheet, I think you're about 19% of the new issue treasury market and about 30% of the MBS market. Some commentators have said, well, housing isn't as big an issue this time as it was certainly in '08 from a dislocation point of view, but you had liquidity and spread issues in the MBS market. You want to take a minute and talk about why you did engage in the GSE agency purchase?
Sure. So those markets are critical for financing the housing industry, and also they're closely connected to the treasury market, as you know. And so it benefits all the financial markets and the general public when the treasury market is working. So in terms of the MBS, there wasn't the capacity and to hold those securities. And what was happening is the very low rates that we were putting in place, they weren't getting through to borrowers. Rates weren't going down. That's because there wasn't the demand to hold the MBS securities. So we had to get in there and get the market functioning again. And I'm happy to say that it is now functioning essentially normally, not perfectly, but that was really what was our thinking.
Well, I think obviously you had people trying to get out of long-dated maturities in the treasury market, and you had prepayment speeds pick up. So I understand why you did it, but you do support moving in the long run to an all-treasury portfolio from a philosophical point of view. Isn't that correct?
Yes, in fact, absolutely. In fact, I had no intention of ever buying a mortgage-backed security when I became the chair.
Right. But, would you say that the repo market and the short-term liquidity markets are now functioning after your extraordinary efforts in March, and you're no longer needed in the daily repo market to the same extent?
Yes, I would say that. I also hasten to add that we're still on alert. We feel like we don't take the gains for granted at all.
Right.
Right.
Well, we're grateful for your leadership, Madam Chair. Thank you for the opportunity. And Mr. Chairman, thanks for being before the committee. I yield back.
Thank you, Mr. Sherman.